Most of the Canadian banks finished reporting earnings during the last week of May. Generally, banks, looking at the banking sector post-pandemic, banks and financial institutions have experienced improved business activity given the continuous reopening, rising rates impacting net interest income, and full vaccination. But heightened inflations and Fed tightening cycles has led to some weaknesses. Banks have increased their share buyback and dividends in 2022, given the significant liquidity on their balance sheet, and they have sparked an acquisitions south of the border. The outlook for the banking sector remains strong, given the reopenings and economic recovery, and the rising rates is impacting net interest income favorably. But the rising interest rate also has accelerated the mortgage demand and home sales volumes. The geopolitical risks, such as Ukraine war, could deepen inflationary pressures and hinder global growth in the second half of 2022, which could lead to a cut in food and energy output and increased risk of a recession. Despite this, Canadian banks have shrunk their allowance for credit losses due to their overconfidence in the lower likelihood of a tail risk event, as shown on the graph. Canadian banks' year-to-date return. By the end of 2021, all the banks' year-to-date returns were in the green zone, and VersaBank had the highest year-to-date return with 73% return year-to-date. It's also the smallest cap stock among all the companies. As we get to the first quarter of 2022, we can see the year-to-date returns are starting to slowly decline, and VersaBank is actually in the negative territory. And by the second quarter of 2022, all of the banks, given the rise in interest rate and the stagflationary environment, where the year-to-date returns have been negative. And CIBC actually experienced the third lowest return, minus 8.2% year-to-date return among all the Canadian banks. During the second quarter of 2022, CIBC missed the estimates. Most of the banks beat the estimates, except CIBC missed it as a result of higher operating expenses on the back of inflationary pressures, higher provisions for credit losses, and lower revenues. The higher provision for credit losses was because of Costco credit card portfolio acquisition and higher funding costs. They acquired a Canadian credit card portfolio, and as a result, the provisions for credit losses increased, which led to an 8% decline in the earnings YOY and 19% sequentially. The Canadian commercial banking and wealth management continued to have a solid quarter, but the other strategic business units, including capital markets, the Canadian personal and small banking sector, and U.S. commercial banking and wealth management, didn't have a stellar performance this quarter. CIBC missed 4 of its 5 performance metrics on an annual basis with respect to operating leverage, return on equity, total shareholder return, and earning growth rate, the 5 medium-term financial objectives that they have set for themselves, mostly because of the acquisitions. And CIBC has maintained the asset quality and liquidity positions, and they met all of the regulatory capital requirements. They also announced a dividend increase from 1.46 to 1.6% for 2022, and they announced share repurchases of 2.2% of their shares outstanding. CIBC actually has the highest dividend among all the Canadian banks, and the fact that they're returning more cash to shareholders means that could signal the lack of good organic projects for reinvestment. However, management have expressed confidence in organic growth as opposed to acquisitions. They also closed the sale of a banking asset in Aruba and acquired Canadian Costco credit card portfolio this quarter, and they completed a 2-to-1 split in April to increase the accessibility of the investment for retail investors. Let's look at the valuation of the company. The banks are valued in terms of an intrinsic valuation based on potential dividends, not actual dividends, but potential dividends, which stands for free cash flow to equity. Potential dividends are what the bank could have actually paid, not what they actually paid, what they could have paid. And it's determined based on net income less the reinvestment in the bank. But what is reinvestment for the bank? What is net capex for the bank? What is the change in net working capital for the bank? What is debt to a bank? Is it the same thing as a normal retail store where we calculate a net capex and change in net working capital as reinvestment? Well, obviously no. The change in regulatory capital, banks, they make money off their debt portfolios and the deposits, and The change in regulatory capital is what's counted as reinvestment rate in banks. Hence, by a forecast of all of the line items in the cash flow statement, determining the risk-weighted assets of a bank and the regulatory capital and the net change in regulatory capital, we can determine a reinvestment in the bank. So net income less the reinvestment. To determine the terminal value, we can look at it in two different ways. We can look at it as net income less the change in regulatory capital, or we can look at it as net income times 1 minus the reinvestment rate. And in this case, the reinvestment rate, which is also retention rate, is calculated as their growth rate, the term growth rate, the terminal growth rate, divided by terminal return on equity. The growth is presented by two components: how much a company reinvests and how well you reinvest. The how well you reinvest is determined by the return on equity, and how much they reinvest is their retention rate, which is 1 minus the dividend payout ratio. So having all of these numbers and the fact that we have a 5 to 10% growth rate for the bank, and using the 5% growth rate would be more conservative, we arrive at a value of $80, intrinsic value of $80.07. At the time, the stock was trading at 70% discount with respect to its value. To read more of these type of research reports analysis, you can head on to our website www.modelizeinvestments.com and visit Basic Modelyze tab. You can see the financial models supporting all of these analysis on the Modelyze store. Thank you, and see you next time.